bought Saurabh Mukherjea from Marcellus and find out what he's been doing in this market.
He's someone you know already. He's no new face to the capital markets. Saurabh Mukherjea of Marcellus.
If somebody is a US investor or perhaps a European investor and they're trying to think about where to allocate their funds, where does India fit into the pantheon of options?
If we look at the data over 10 years, 20 years, 30 years, India stands head and shoulders above any other emerging market. The dollar returns over 20 years, I think, at 10.5. I think only market in the world, emerged or emerging, amongst the large markets, the only market which has matched India shoulder to shoulder for returns over 10 and 20 years is the United States, right? No other emerging market is even in the same ballpark as India.
From your experience, how do you define a successful money manager?
What I think that really distinguishes the legends from the rest of us, including myself and a relatively ordinary category, is the ability to utterly insulate yourself from what the world is saying.
This podcast is sponsored by the Capital Alliance Mastermind, a private community where fund managers share deal flow, build relationships, and grow together. Join the waitlist in the first link below.
Hi, everyone. It's my pleasure to welcome you back to another episode of the podcast. I'm going to let Vatsal introduce our guest, Saurabh Mukherjea. I had the pleasure to meet Saurabh in India when I was there just about a month and a half ago. Saurabh was generous enough to meet with us and share his insights. And I'm very excited to have him share, I think will be a fantastic episode. So Vatsal, why don't you introduce Saurabh?
Yeah, thank you, Ken. And it's a great privilege to have Saurabh with us today. So Saurabh needs really no introduction in the investment world in India and globally. He's the founder and CIO of Marcellus Investment Managers. And he was also the co-founder of Clear Capital and the CEO of Ambit Capital right before setting up Marcellus. He was educated at the London School of Economics, where he earned a bachelor's and a master's in economics. And he's also founding director of the Association of Portfolio Managers in India and continues to be a part of multiple SEBI working groups. But I think most importantly, and I can say this personally, I think Saurabh has probably been the best teacher, and he's democratized investing to the Indian public. And the way he has taught us stock picking and portfolio management, I think no other money manager has done it. And he's a prolific author, extremely erudite. And some of his books that I've really enjoyed are Diamonds in the Dust, Coffee Can Investing, and The Unusual Billionaires, which is a personal favorite of mine. So with that, thank you for coming today, Saurabh.
Thank you, Vatsal. Thank you, Ken. Thank you for hosting me.
Yes, our pleasure. Interesting. Coffee Can Investor was one of your books. I haven't read or gotten even copies of most of your books except for the last one that you gave me.
That one is actually just now been translated into Thai, believe it or not. Hitherto it had been translated into Hindi and Marathi. So originally published in English in 2018, then translated into Hindi and Marathi during COVID. But out of the blue, 2 months ago, Penguin wrote to us saying, Penguin Thailand wants to publish it. So hopefully next time I go to Thailand, there'll be people who'll know me for Indian equities. So one of the perks of our job.
Yeah, that would be great. I'm familiar with that concept only from a guy named Bob Kirby.
Absolutely.
Capital Group.
So we learned it from him. And Vatsal mentioned Unusual Billionaires. So 2014, Ken, I was having dinner with two friends of mine. One of them is from Capital. He still is Capital's main man in India, Nirup Datta. And the other friend was a guy called Sanjoy Bhattacharya, again, celebrated investor in India. And over that dinner that night, 11 years ago, they told me about Coffee Can Investing and Bob Kirby. I hadn't heard of the great Bob Kirby until that point. So when I jumped into the taxi, I Googled Bob Kirby, Coffee Can Investing. And I read the paper on the taxi on the way home. And by the time I got home, I said, this can be applied to India. Yeah. And then I played around with a few things as to how do you apply Coffee Can Investing to India? How do you find a bunch of great Indian companies and hold on to them for long periods of time? And ultimately, after a year of fiddling, we figured that ROCE, return on capital employed, and revenue growth would do the trick. I still remember 2015 summer is when the first back test. We did a back test going back 25 years. And if you bought stocks basis ROC and revenue growth, what would happen? And the short answer was you'd make a ton of money. And that for me was a pivotal point in my career. So I have my friend Shanjoy and Anil to thank for telling me about Bob Kirby's paper, and I have the great Bob Kirby to thank for writing, I think, one of the most powerful four pages in finance.
Yes, I agree. It's actually really interesting. So one of my current partners, Terry McGuire, who works with me at Ridgewood, he's passionate about dividend growth investing, but he was a partner at Capital for many years. And so when I started Ridgewood, or maybe just before, he was already working at Capital, and he shared that paper with me.
Right.
At the time, very few people knew. I don't think it was publicly available on the internet. But of course, I read the paper. It very much aligned with my thinking, because that's generally what I did. Is I bought stocks or things that I thought had merit, and I just held on to them. So
it worked out nicely for you. The interesting thing, Ken, in this is there are some people who read the paper and say that this is rubbish. This is not going to work. How can you hold the same companies for long periods of time? The world is dynamic. There's so much change.
Right.
Surely you have to do something all the time. And I found that the world separates into two camps: people who instinctively understand coffee can investing and those who don't.
Yeah, interesting. I mean, it was my approach before I read any papers. It was just somehow appealed to me or made sense. Probably because I'm lazy and I don't want to do a lot of work.
I think there might be many of us in that same boat as you.
Yeah, buy some good companies, get rich. I mean, what's wrong with that? I didn't have to do any trades. I didn't have to pay any taxes. Just that's it. I love it. Boring is best. But there's interesting. I think that I would say persuasively, there's a lot of evidence that it's actually the better way, because I'll give you one metric that has come to light. So the venture capital firms, they've basically funded all these great companies, but then they sell them after 10 years to exit their fund. And it turns out that if any of the top firms had held on to any of their stakes, they would have done so much better than if they exited them.
Fascinating.
So that just tells you that, and it's not even close. It's like trillions versus billions,
Right.
So it's an incredible validation of the coffee can concept, but yet in a very different concept that we can't obviously implement, being that we're not venture capital investors. So what I want to do is go backward, Saurabh. So tell us about your origin story. Sort of how you started, when you first thought about, going into the business of investing, what other businesses perhaps you worked in, or what other careers you pursued. Tell us about the evolution, where you grew up, and how that led to you being a partner in Marcellus.
So look, I grew up in the suburbs of London. And honestly, I had no idea about asset management when I was growing up. I was a regular immigrant kid growing up in the suburbs of London. I got admission into the LSE, went there for 4 years. Incredibly, even at the LSE, I really had very vague ideas about asset management. Luckily for me, one of my professors at the LSE was a renowned strategy guru, still is, Sir John Kay. And Sir John took me under his wing and asked me to join him in a strategy practice after I graduated. So I worked with him for 3 years, and he would take me along to board meetings. I would sit and listen to. My job was to carry his bag and summarize the board meeting and play it back to him in the office so that he could then give advice to the board. And as part of that, he sent me off to the UK regulator, help the UK regulator create their rule book. So not the most usual thing for a 22-year-old to do, but I learned a lot creating the rule book for the UK regulator. And that's when I first came across asset management. So I was 23 when I first realized that there are people like us who get hired to analyze stocks, and we give recommendations to fund managers, and they buy stocks, and if the stocks do well, then the fund manager's fund AUM grows, and you can get promoted as an analyst. So I thought this sounds like a lot of fun. So I went and told John, look, I want to do this. I think I can do this. I passed my CFA exams. I studied on the local train up and down on the commute to work and passed my CFA exams. And I told John, I think I want to do this, and I think I can advise other people on what stocks to buy. So John was not only supportive, he said, I'll give you a bunch of my money to get you going. And he became a seed investor in Clear Capital. And I got together with a few other people, and we started advising British families and the Fidelities and Capitals in the UK on UK listed small caps. So my entry into this profession was 2003 through British small caps. That firm, Clear Capital, made a name for itself in small caps. We became profitable pretty quickly. So when I was 30, when I turned 30, I was voted amongst the top small cap analysts in the UK. But Ken, then life took a slightly different turn. It was Jan 2007, I remember, when I figured out that the UK financial system is going to blow up, right? And I wrote a 50-pager for our clients explaining why the UK financial system is going to blow up and which banks and which lenders are going to go under. And then I followed up with 4 or 5 50 pages over the subsequent months. And by July, August 2007, we've got most of our clients out of British stocks, right? And it sort of spread the word around the UK that there's disaster coming. That's when, towards the end of 07, my wife said that, look, if you're so convinced that this system's going to blow up, well, why do you own a small financial services company in the UK? And I thought that's a good point, and we put Clear Capital up for sale. We put the firm up for sale in Jan 08. May 08, we found a buyer. And that month, 11th May 2008, we sold the firm and I migrated to India. So that was the end of my career in the UK. And 2008 is 17 years ago when I arrived in India. First couple of years were spent understanding India, and specifically was spent understanding accounting fraud in India, which I still believe is a meaningful challenge in our country. Then a firm called Ambit hired me. Initially, we were hired to build the institutional broking business, then the wealth management, and then the asset management business. That's where I wrote Coffee Can Investing, Unusual Billionaires. I spent 9 years working at Ambit. It was a lot of fun. We built 3 very profitable businesses. Proud to say that they're still very profitable. It's been 6 years since I left Ambit. Those businesses are still making money hand over fist. And 2018, I decided that I turned 40 then, 41 actually. I turned 41 and I said, it's now or never if I want to set up by myself. So August 2018 is when we set shop. Took us 3-4 months to get a license. And originally the plan, Ken, was to manage $100 million for friends and family, perhaps make $1 million or so in performance fees and have a nice, comfortable suburban life. But by then the books had become very popular. Marcellus mentioned Diamonds in the Dust. We published that subsequently. That also became a bestseller. We discovered in 2020 that we could do something called podcast. Till 2020, I'd never seen a podcast in my life. During COVID, we discovered something called podcasts. India discovered social media and YouTube, and the combination of books and podcasts took us from our aspiration of $100 million. It took us towards $1 billion, and we ended up managing a mixture of local money and institutional money from the Western world. So that's where we are. It's been a lot of fun living in India. There's never a dull moment. Plus, America is now adding to the excitement. Can't complain. We just don't get 5 hours to sleep at night, and we're very grateful that we get those 5 hours. But other than that, it's been a lot of fun living in this country, working in this country.
That's great. Thank you for sharing that backdrop. So tell us about the process of saying, oh well, if it's now or never, so I'm going to start my own firm. How you went about doing that, thinking about that, and then who you partnered with, and what that process was to get that up and running and thriving.
So look, in retrospect, I can make it sound very rational and logical. And I always like to tell people that the way I did it was I had a broad estimate of the probability of success multiplied by the payoff for success minus the probability of failure and the downside from failure. And I'd like to believe that was a net positive number. But in the summer of 2018, when my wife and I were doing the maths on this, it was an EV plus bet, it was a net positive bet. It was also nerve-wracking, right? Our children were entering their early teens. We would have to save up for their university education. And also, I didn't have a great deal of money. I had roughly $1 million to invest. And whilst that sounds like a lot of money, perhaps in some other countries, in India, of that $1 million, you need to put half of it up as a red cap. So if I put half of the $1 million up as reg cap, that didn't leave that much cash burn for us to do this on. So it was nerve wracking, not because I was worried about the future viability of the business, but I was worried as to whether I had enough money to make this work out. So I reached out to a few people that I knew in the city, and I said to them, "Well, look, you want to build this business? I need a strong guy in compliance, a strong guy in technology. I need a strong fund managers. I need good analysts, and there's probably 7 people that I needed: sales, tech, compliance, HR, fund management, and research. And I reached out to the best people I could, right? So I literally did the kind of Avengers type thing. And I remember I assembled all the Avengers in an office in Midtown Bombay. And I said, this is what we want to do. This is the future. Got them all worked up. And then I said, just one small problem, boys and girls. We have no money to do this with. Right? So there was stunned silence in the room. And then I beamed up a spreadsheet. And I said, look, here's the spreadsheet. Here's your current pay. Here's what I think is fair value for you, fair value for you in the Indian job market. And if you guys agree to work for 2 years without pay, I'll translate that in front of you into a stake in the firm. And we'll build a firm where at the get-go, you'll have a hefty stake. I'll put my money in. I'm not asking you to put money in. Whatever salary you sacrifice will become a stake in the firm. And we did that, and it worked out. For exactly 2 years, we didn't pay salaries. And in the 25th month, we started paying people properly. But those founders, the 7 founders, ended up owning a big chunk of Marcellus. And thankfully, that's worth a lot of money today. But that's how we got going. That's the origin story in its rawest form, right? Whilst I did the math on probability of success, I only had $1 million. And I had to build the business with $1 million. I needed top talent. And at the outset, I got them into a room, gave them perfect clarity on what the odds were, and said that if you give up your salary, some of them needed a little bit of money to get by, and completely understandable. So from my $1 million, we cut out salary checks. But those guys put their backs into it. We were lucky as well. We were extremely lucky that the post-COVID euphoria was good for our portfolio. And I think 2018, 19, 20, 21, for 4 years, were great numbers, which brought the AUM in, and allowed us to not just pay salaries, but build a larger business.
And so what's the scale of the business now, and how did it
So
scale?
we peaked at $1 billion odd. At the moment, we are at $700 million odd.
Okay.
We underperformed through 2022 and 23. And through 24 and 25, performance has picked up again. But good to see the underperformance for 18 months starting in Jan 22 through the summer of 23. That underperformance resulted in outflows. So from a peak of $1 billion, we're down to $700 million.
Got it. And what's your fee structure to investors?
So we offer clients a choice. They can either pay us a fixed fee of, if they are in India, roughly 2%, if they're in the Western world, 1.5%. They can either pay us a fixed fee, or we work on a performance fee basis where the fixed fees are 0 Ken. And we take 20% of the upside in excess of a hurdle of 6%.
Got it.
So interestingly, as you would imagine, most people choose the zero fixed fee construct. And that means that in years where we beat the benchmark, and usually when we beat the benchmark, we beat it by a country mile, we end up making a lot of money. So effectively, we're taking risk on ourselves.
Mm-hmm.
We're taking risk on ourselves, and we end up earning a little bit more than the 2% because we take risk on ourselves. So there are years where we earn very little money,
right,
because the performance fees don't come through. But then there are years where we make many tens of millions of dollars, and those years make up for the bad years. And from the day we created the firm, we created a policy that we'll keep on the balance sheet at all times 2 years of operating expenses.
Mm-hmm.
So by and large, we're fairly frugal with our expenses. We've seen our offices. So we've ended up with close to actually now 3 years of operating expenses on the balance sheet. And that allows us to offer more people the zero fixed fee structure. But the earliest cohort of clients have figured this out. The earliest cohort are increasingly toggled away from performance fees to fixed fees. And that's only fair, right? Once you understand how we have done the maths, and once the client understands that, we will end up making more money through performance fees.
Right.
Entirely within their rights to shift to a completely fixed fee.
Are most of your clients institutional clients from outside India, or how is
Yes, so in India, we don't really have institutional clients. We only one institutional client in India, which is the Indian Navy's pension fund, right? And I think we probably have a couple of other corporate treasuries. But India, as yet in India, the institutional asset management business hasn't yet been born. It's Indian pension funds don't give mandates to Indian fund houses. The government of India doesn't either. The Indian Navy being a rare exception. Sorry. Outside India, most of our clients are institutions. In Europe and North America, it's pension funds, churches, universities, and so on.
I see. Okay, that's very helpful. So how, you know what I loved about what you said, and it's part of the reason we have Capital Alliance, is that I think there's a lot of people who don't start a business thinking about scaling a business and thinking about bringing in the best people and creating systems and processes. And it sounds like you started that way from day one, which is extremely rare from what I've seen.
So part of it was I'd run a large business before. Sambit was a very large, successful brokerage, asset manager, wealth manager. And rightly or wrongly, I had seen that if you want to scale in India, as I'm sure many people listening to this know, India has a fairly evolved regulatory structure. We also have multiple regulators. There's the Securities and Exchange Board of India. But if you run a business like ours, you also have to contend with the Reserve Bank of India. There's obviously the government of India's rules and regs. And I realized that if you build a business which is, say, tens of millions of dollars of revenue in India, you have to interface proactively with multiple regulators, keep them on side. And it's very difficult to do that as a sole proprietor. Unless you have strong people in compliance, in finance, in technology, it's not just good enough to say, I'll have a few great analysts and some good fund managers. The support functions have to be world class. And I saw that and I learned that the hard way, my preceding job.
Yeah, that makes a tremendous amount of sense. So having taken that approach, which I think a lot of others can learn from, what would you say were the things you got right and the things that you know, if you look back, you say, hey, I could have maybe tweaked this approach?
Yeah, I think let me start with the things we got wrong, right? We had never anticipated in our wildest dreams that the first 3.5 years we'll have this sort of blockbuster performance. I think we beat the index by 700 bips in the first 3.5 years. The money literally flowed in, tens of millions of dollars would flow in every month. And I remember for the first 3 years, I would just try to deal with people's emotional breakdowns as they would deal with overwork. Right? And remember, COVID also hit during that time. So we were sitting at home. My colleagues were sitting at home. The phone was ringing off the hook. Various regulatory restrictions were kicking in. People were dealing with their personal traumas with COVID. And we had staff breaking down, just emotionally breaking down, not being able to deal with the pressure. We created a psychological helpline for overstressed people overstressed colleagues to turn to. But in retrospect, I think we burnt 4 or 5 people out, which we needn't have because of the sheer volume and intensity with which the money came in, right? And in retrospect, if I was wiser and if I was a more seasoned operator of an asset management house, I would have probably put a lid on the inflows when the going was getting so intense, right? Because as it happened, I told you, money came in and then some of it went out. So rather than having to go through the emotional trauma of seeing the money come in and then see it go out and burning through good people, had I been wiser, smarter, I would have realized that both the alpha of the fund and the intensity of inflows was suggestive of a peak for our style of investing. I wasn't smart enough to spot that. And then applying that on the investing side, Ken, if I look back, right, 2021 was a year where I think I lost sight of valuations, because by then we had 5 great years, 17, 18, 19, 20, 21. We had 5 great years. As I said, we hit $1 billion. I think we were the fastest firm in India to hit $1 billion. And much of that was done literally out of this sitting in this living room. So I think by 21, in all honesty, looking back, 2 years of COVID, wild roller coaster ride of building a company, I think we'd lost sight of all sense of reality after sitting in this room for 2 years. So I lost sight of valuations. Had I been building the firm from scratch, had I been wiser, I would have had some outside advisor looking in, saying that, look, Saurabh, stop taking money, stop block inflows, shut the firm to new inflows, look after your staff, tighten up on valuation, tighten up on valuation discipline, sell those companies that have doubled and tripled on you through 2020 and 21. I think had we done all of those things, Ken, we would have probably had an easier time through 22, 23. But I think the great thing about our job is whatever lessons you don't learn yourself, the market teaches you. Market teaches you those lessons in double quick time. And so 23, 22 and 23 were humbling years. The market humbled us. We learned our lessons. And I think we came out of that in 24 and 24, 25 have been much better years for us, both from a investing hygiene perspective and from giving our staff a more reasonable lifestyle perspective.
Thank you. I want to call you out for the vulnerability and the openness of that share. That's really a lot of what we're trying to create in our community at the Capital Alliance, and I think there's a real power to that, both humility and vulnerability and sharing deeply.
And it's interesting you say that. Thank you for saying that. And it's very, very, when you read about other fund management houses, right? Other than stories like LTCM, other than books, stories like LTCM and the book that Michael Lewis wrote on them, there aren't too many other sort of battlefield stories where you get to hear where a founder talks about why he wished it scaled slower than faster. Most of the stories you get to hear is founder starts out alive, he gets to $1 trillion super fast, and he becomes a master of the universe, and then perhaps runs for high political office. Right? Those are the stories which get seared in your mind. That the fact that there are probably plenty of other founders, operators, and asset management who've gone through a similar cycle to mine. I hope that Capital Alliance allows them to share these stories, because I think it's an important learning. Otherwise, you just go through needless trauma and you put your clients through a roller coaster.
Actually, yes, because in fact, the reality is that when you see those stories from the outside, it's probably not the whole truth. It's half the truth. Everybody has struggles and issues. So the Capital Alliance is a space where we as professional money managers come together, and in a spirit of sort of giving and vulnerability, we openly ask for help from each other, and we share our best stuff, our best insights, especially the really hard ones which came through mistakes or problems that we had to deal with. And we can share it with each other in the hope that it helps other people not having to repeat the same mistakes. I have this thing where I say I'm constantly making mistakes and learning. They're just different mistakes, usually, hopefully.
I think we all are, and we're all making mistakes and learning. That's the only way to grow in life.
So one more question I want to ask you, and then I'll turn it over to Vatsal to ask a few questions. So I know you're a prolific author. You wrote quite a few books before Marcellus, and obviously since Marcellus. You talk about how you think about you have a business. Every business has to grow through marketing and or sales. So how do you think about the role for professional investors who are, who have outside clients, the role of sort of writing and of writing books specifically, and how you leveraged that status as an author to grow Marcellus when you from startup to what it is now. If you want to go further back to some of your prior businesses, because I guess that was part of your approach there, that would be great too.
So I never really set out to be an author of multiple books. What happened was around 12, 13 years ago, one of the editors of a popular business newspaper in India, it's called the Business Standard. One of the editors of the Business Standard came to my office and said that, look, you write a column. I used to write a column for a venture capital website called VC Circle. So he said, you write a column for VC Circle. I've enjoyed reading your column. Do you want to write a book? And if you do, then Business Standard, this newspaper also had a publishing arm. The publishing arm for Business Standard will go ahead and publish it. And initially, I just said, this doesn't make any sense. I've got a full-time day job. How can I write? And then I spent 6 months, just dwelling through how I wanted to learn more about the trade. And at that time, this is 2012, 2013, I was meeting a succession of portfolio managers in India, fund managers in India, asking them how they had cultivated their investing style, what are the mistakes they had made. In a way, Ken, the primitive version of capital alliance, right? I was going from fund manager to fund manager. After doing 3, 4 of those meetings, I said, hang on, if I could record the battlefield stories of these fund managers and with their permission, turn it into a book, it'll help the Vatsals of the world who are coming through. But it'll also help me. It'll clarify my thinking. Because if I want to turn out a polished manuscript with, say, Shanjay Bhattacharya's thinking or Shankaran Naren's thinking, if I want to turn it into a polished manuscript, I'll have to ask good questions, cultivate a style of asking questions which elicited deep answers. So I went back to the Business Standard and I agreed to do the book. That book worked out really well, and that became a bestseller. That led to Penguin approaching me for the next book. And I said, now why don't I turn the mirror to the corporate side? Let me ask some of India's greatest business founders whether they would be willing to tell me their story. And it turned out they were. And that led to The Unusual Billionaires. By the time The Unusual Billionaires had come out, I had figured out coffee can investing from the great Rob Kirby. And that led to coffee can investing. And then I realized what was happening, right? The first 3 books happened because of my own desire to learn about investing, about capital allocation, about corporate strategy. But I realized what was happening was because unlike America, India is still a virgin market for investing. 95% of Indian household assets are still in physical assets, gold and real estate. So unlike America, India is still virgin territory when it comes to investing and corporate strategy. I realized that there's a vast market where hardworking, affluent, intelligent Indians want to read about their country. They're happy to read about Warren Buffett. They're happy to read about Bill Ackman. They're happy to read about Blackstone. But as in any country, people want to read about their own country as well. And there wasn't enough content at that time. So we're talking 2017, 2018. And I joined the dots and said, hang on, if I can write newsletters, right, which become a monthly thing, and if those newsletters can then be coalesced into a book once a year, then I could kill many birds with one stone. I help the Indian public learn about investing, about corporate strategy. I clarify my own thinking, and through the newsletter we also create a vehicle. Which can spread the word about our marketing style. So it was only around 2017, 2018, Ken, where the whole thing coalesced in my head that I could serve multiple purposes if I was able to publish, say, one good 2,000-word newsletter a month. And I think all of us in our trade end up taking a lot of flights. And there's only so many movies you can watch on a flight, and there's only so many podcasts you can listen to. And I started using my flights to write that one good 2,000-word newsletter. And then if you put a few of them together, you get a book. And that's the sort of cycle I've tried to create. It works usually, sometimes it doesn't work. And then as the years have gone by, I've tried to deliberately write. And since you're saying this is not going to go to my publisher, I deliberately write a book every other year, which shouldn't have any audience. Right? So I write one book on money, on investing, but I write one book on psychology. Right? So I intersperse the books on investing and psychology. The psychology books are largely my trying to explore different aspects of my mind, of other people's vulnerabilities, mental, psychological development, skilling, and then I intersperse the books on psychology with a book on investing. So that way it keeps me hungry, keen to explore different topics. It gives me a way to relax on long flights rather than watching movies. And I think it gives the Indian public, and especially the younger generation like Vatsal, content which they can get their teeth into and go into the wide world and start becoming investors themselves.
This podcast is sponsored by the Capital Alliance Mastermind, a private community of asset managers and investors building something real together. Members gather in person a few times a year to tackle the hardest problems in investment management, raising capital, scaling operations, and building relationships that move the needle. What makes it different is the room itself. These are people who share deal flow, make introductions, and hold each other accountable, because everyone is committed to giving, not just taking. We're currently building our next cohort. If you manage a fund, join the waitlist in the first link in description.
Um, Saurabh, so I think you've had a lot of success as a fund manager, and you've really um, worked across many years in this industry, and you've interacted with countless investors and fund managers. So from your experience, how do you define a successful money manager, or what does it take to be a successful money manager?
So look, there are usual traits, which plenty of other people have spoken about rightly, such as humility, such as hard work, uh, such as clarity of thought. Right. So those are I think almost necessary hygiene traits: humility, hard work, clarity of thought. But what has if I look back, what I think really distinguishes the legends from the rest of us, and I'm including myself as a, in the relatively ordinary category, is the ability to utterly insulate yourself from what the world is saying and hold a very differentiated, very iconoclastic view, almost to the point where the world ridicules you. That's very hard to do. It's very hard to do because human tendency, evolution has made us followers of herd instinct. And what I find that the best investors are able to do is ignore the sort of deep desire to be accepted by the herd, to follow the herd, to do the conventional thing. The best investors are able to almost stand outside the herd, stand at one remove from everybody else, and take a point of view which almost looks mad. Right now, courtesy, the 2008 Lehman Brothers blow up, and courtesy Big Short. I think Michael Lewis has captured it beautifully. But if you're just using the Big Short as an analogy, if you see the stars of the Big Short, the people who were sitting in California and shorting the living daylights out of the mortgage-backed securities market, none of them were conventional Wall Street fund managers, right? And this aspect of being an outsider, you might not be an outsider by social disposition, right? But you're an outsider psychologically. This aspect intrigues me no end, right? And it's one of the areas that I want to keep digging further as to why is it that some people are able to distance themselves intellectually, psychologically from everybody else in their peer group. They've gone to the same college, they speak the same language, they wear the same clothes, and yet they hold a completely differentiated point of view on an important subject. And even though other people are calling them out saying, look at him, what a moron, it doesn't seem to affect them at all. Right? And that I find intensely fascinating. It's one of the most, I think, remarkable aspects of our profession. It's harder to do this in, say, sport. In professional sport, if you as a professional sports manager manage your team very differently from other people and have a few losses, you get sacked pretty quickly, right? Similarly, in Wall Street, as a CEO, you do something very different and you don't deliver results fast. The board gets rid of you. But in professional fund management, especially in boutique professional fund management shops, provided you are willing to take the pain, willing to take the pain of the consequences that come from underperformance, you can take a differentiated point of view for an extended period of time, and then if it works out for you, it makes you so rich that you don't have to worry about what other people are saying. This aspect of our profession, where if you have a very distinctive view about the world, and you have the guts and the courage of your convictions, and you're willing to stand by it, you can be a big winner. But only a certain type of persona is able to pull it off. Right. So if I look back at, say, Pulak Prasad, right, and Pulak Prasad has written an outstanding book, what I learned from Darwin, right? In this book, he explains how he started out in 2008, how first 7-8 months it was a disaster. He underperformed. The firm was underwater. He asked his investors for more money after the fund was down sharply after the Lehman debacle. Courtesy the legal agreement that the investors had signed, they were compelled to give him more money. And then, as India recovered from Lehman Brothers, Pulak's fund performed. And even to this day, when I meet Pulak, he's one of the most remarkable investors. He might not know the PE multiples of his investee companies, but he knows way more about fund management than most other people because he's approached it with this evolutionary framework in mind that I will buy companies that have stood the test of time, and the kind of Darwinian test of time, And I will buy them when everybody else is throwing them out, a crisis like COVID or Lehman Brothers. And then I'll sit on them for years to come, even though others might say, look, company's underperforming, you should sell it. Remarkable, right? I might not be able to do what he does, but I'm just so keenly interested in understanding this psychological aspect. Why is he able to do it? Why can't lots of other people do it? Right? That aspect is, I think, what really separates the men from the boys, the women from the girls in our profession.
Absolutely. And I think similarly, right, like Buffett didn't choose to be in New York until, of course, he worked for Graham. He went to Omaha, or somebody like a Chuck Akre went to Middleburg, Virginia, a village out of in the countryside. Saurabh, I want to shift gears a little more towards the sales and marketing side of fund management. Right? So um, you are a student of psychology. It deeply interests you. Can you talk to us a little bit about how do you view the consumer of a PMS product, or the consumer of or the customers of a fund manager? Like what do you think is in their heads in terms of when they give you money? What are their expectations? What are they thinking? And how do you approach sales from that perspective?
Yeah, so I think there's three things we've tried to keep in mind wherever we have sort of forgotten these three things when we go marketing. I think it has cost us dearly. The first is most people, especially affluent people, don't have much time. So they might give you a 1 hour video call or a 1 hour meeting, but effectively you only have 20 minutes. After 20 minutes, if you haven't got into their minds, the rest of the meeting is, we call it in India, time pass. So again, time pass in India is sort of, as the name suggests, is just going through the motions, right? So, so therefore, you have whatever you want to, whatever impression you want to make, whether it's a podcast, whether you are doing a video call or a face-to-face meeting, it's 20 minutes, right? In that 20 minutes, if you want to think of it in PowerPoint terms, you've got 5 slides maximum, right? In that 5 slides, you have to make an impact. If you haven't, you might have the world's best performance numbers, but it might not. Your chances of conversion suffer. The second is that typically with wealthy people, they're not just looking for returns. They're also looking for something that they can go and tell their relatives, their friends, and gain social acceptability. So this was one of the gaps I spotted when I set up Marcellus, right? So in India, Ken, we have a bike called Royal Enfield. It's our equivalent of Harley Davidson, right? And in spite of President Trump getting tariffs on Harley Davidson removed, I hope Royal Enfield continues to do well because I'm a shareholder in it, right? But what really struck me about Royal Enfield was that people proudly tell you I am a Royal Enfield owner, right? And Royal Enfield has a thump to its engine when it goes down the street. Everybody knows a Royal Enfield goes down the street. Now, but for affluent people, it doesn't cost a great deal of money in India. It's 250,000 rupees, or 150,000 rupees, which in India is a modest sum of money for affluent people. And the run-of-the-mill bikes cost only a third less. But I realized that affluent people love to be seen on a Royal Enfield, whereas they don't want to be seen dead on a run-of-the-mill bike, even though the run-of-the-mill bike is only a fractionally cheaper. And I figured out that the way it's been styled and presented and positioned in people's minds, and I think incredibly cleverly positioned by Siddharth Lal in people's minds, is that this is a class product. Someone of your stature, Vatsal, someone of your stature, Ken, this is the bike you own. The other bike, even if they are same price as Royal Enfield, the other bike is for the rich, right? And I said that, hang on, that space is open in our profession, right? In our profession, that space is open. If you are in a cocktail party in South Bombay, do you really want to say that I have a fund from the local high street bank? Or do you want to say I have a fund, I have a portfolio run by Marcellus, right? So I figured this second piece out, that there is a social cachet that in America arrived probably 10 years ago, but only in the last 5-6 years it arrived in India. And I guess we were reasonably early to latch onto that. So 20 minutes, social cachet. And the third piece is the product itself has to have a narrative, right? So this piece I learned from my days with John, right? So John had taught me very early on. John had taught me, sell the features, not the product. So I asked him, what do you mean, John? He says, well, if you're selling a washing machine, Do you really want to tell the customer this is the size of the cylinder, this is the perspex glass, this is the electricity, this is the circuitry? Customer is not interested. What the customer wants to know is this will wash your clothes to a greater level of whiteness in 15 minutes. It's environmentally friendly. It'll save you electricity, and you can operate it with remote control from your office. That's something like that, right? So sell the features, not the product. So we brought that to portfolio management, right? So this is the consistent compounder portfolio. It consists of India's best companies. They have high return on capital, twice the market average. They've compounded at X% over the last 20 years. Right? Simple. Don't get into the next 6 months, market psychology, macro, your sector rotation strategy, how you and your analysts build 55 spreadsheets to identify companies. That sort of thing is important. If somebody wants it, they will ask you for it. In those 20 minutes, and we try to train our salespeople. And in fact, just before I got on the call with you, I was talking to our sales heads that let's keep refreshing the training, that these are the three facets to fund management. 20 minutes, compact pitches. And if you ask me, when we started off was 20 minutes, now that social media and reels have made people's attention span smaller, it's probably now perhaps 10 minutes. Social acceptance. There's a lovely book by Peter Thiel's friend. It's called The Culting of Brands, right? So I read that early on in Marcellus's in existence. The Culting of Brands. It's about how do you build a Harley Davidson type brand. It's a motorcycle, but it's not really. It's a persona, right? How do you build a brand which becomes a customer's persona? And the last thing, how do you sell the features rather than the product? Culting of Brands is by a guy called Douglas Atkin. Very simple book, but I found it very useful. It's all the case studies are American case studies, but I think we're perhaps the first people to apply it in asset management, which is seen as a utilitarian.
Let me ask something.
Yeah.
How did you, from when you started Marcellus, and maybe you had relationships before, how did you identify sort of potential clients who you could reach out to and cultivate the relationship?
Yeah, that's very interesting. So I reached out to friends and family, right? It's sort of this naive hope that they'll all give me a little bit of money. Some did, Ken, did, but most didn't. And most didn't. Then one of India's most famous venture capitalists, Sanjeev Bikhchandani, I met him and I pitched to him. I've known Sanjeev for many years. He's a celebrated VC. He's founded a company called InfoEdge where we are now shareholders. He also went to my school. So I met him and I said, look, this is what I'm doing. So Sanjeev said, you write books, don't you? I said, yes. He said, do you put your email address at the back of the book? I said, no. He said, why don't you put your email address at the back of the book? People like the book, they will email you and you can get some business. I said, okay, thank you. And I went off and did that. And Sanjeev had predicted, people started calling up, read the book, we liked the book, how do we invest? Then I met him a year later and he said, so-and-so, the Indian equivalent of CNBC and so channels, the Indian equivalent of CNBC, my friend comes. He's just a local stockbroker. He's not a fund manager, but he explains stocks in the vernacular, in Hindi, in such a way that the fellow driving auto rickshaw, driving a tuk-tuk can understand that this is the stock to buy. So why don't you do that? And then at that time, I was still just come out of an investment bank and I fancied myself as catering only to the elite. So, I swallowed my pride and I started doing, at that time, for conference calls that subsequently became webinars. And I kept this image in mind of Sanjeev's friend speaking on a Hindi channel on CNBC type Hindi and explaining what stocks to buy, but in a language that the rickshaw driver would understand. And that combination of writing books and putting our email address at the end of it and doing podcasts, simplifying investing for people, that's how most of the business came in. My friends and family gave us a little bit of money to get us going, but the real impetus came from, I think as Vatsal said, from democratizing investing in India. it brings with it its pros and cons. And as soon as the democratization started, I realized that just as we are sort of popularizing investments, whatever mistakes we make will be amplified, and we'll have to live with the consequences of that. And some of that we've lived with in 22, 23, and 24. But that's fair game. I think if you're choosing a certain medium through which to go out and tell the story, and the medium works. Uh, Believe it or not, we've never gone marketing to America, right? When the American phone calls started coming in. In fact, just as I knew nothing about asset management 20 years ago, I actually knew nothing about endowments and pension. But I sort of knew about them in the abstract. I'd read about them in LTCM and various books, but I'd never gone pitching. COVID had interrupted. During COVID, the American institutions started calling up, and we had to learn a very different style of explaining investing on Zoom calls through 2020, 21, and 22. And it was only in 22 summer, 4 years after Marcellus had been created, that I went to Europe and America for the first time to meet institutions. And then gradually what we realized was we need to separate the firm. The high net worth and retail piece was separated out, and the institutional piece was separated out, because the communication is very different to the two different audiences.
Makes sense. Can you talk about the differences of setting up and running an asset management operation in India versus the US, pros and cons, and if you know, and also let's talk about the Indian markets a bit. What's interesting about them, or not, good or bad?
So look, I haven't run an asset management business in America. I've seen other people do so, and I've run an investment advisory business in the UK. So basis whatever I've seen of American asset managers and my lived experience in the UK, I think the three big differences are, because those are more mature markets for investing. The amount of legwork you have to do in communication is less in the Western world. In India, simple things like a company with high ROCE deserves a higher valuation than a company with lower ROCE. You have to really work hard to explain that. If you tell an Indian high net worth investor that said company has a higher ROCE, sir, and that's why it deserves a higher valuation, we just look at you as if you're talking gobbledygook. Similarly, if you say, well, Harry Markowitz and portfolio diversification, this and these two stocks go together because it reduces the standard deviation of the portfolio. Again, they'll look at you saying, what are you on about? So the legwork you have to do in thinking through how to speak in simple terms. You can't sort of patronize people, because these are wealthy, powerful, smart people. You can't patronize them, but at the same time, you have to simplify it. Otherwise, that 20 minutes of window that you get to pitch is gone, right? So a lot of what the economist style of writing, the economist style of speaking, we have to learn a lot of that over here. The second big difference is, in your country, in the West, the regulatory construct is a given. In our country, we've had to work very hard to go to the regulator and say, look, Mr. Regulator, we need these 3, 4, 5 rules to simplify the process of investing. For example, until my industry counterparts and I created the trade body for our industry, physical pen and paper sign up was mandatory for our industry. Right? They have to go to the regulator and say, hang on, why can't we sign clients up online like this? And rather than pen and paper, can't they type on the screen that they have read and understood the terms and conditions and they're happy with it and so on, full stop. Right? So the regulatory construct that Americans take as a given, we in India have worked and still working, by the way, to get that laid down so that the playing field is even, rather than the playing field having stones and boulders on it. And the third aspect is the scale. Right? Already India has 200 million retail investors. I think America has 300 million people. Right? India has 200 million retail investors, Ken, and we're just getting started out in India. Right? 95% of wealth is still in physical assets. I reckon Indian physical assets are $10 trillion. So as physical assets port from physical to financial, this is already the world's 5th largest market. It'll probably a decade hence be the second largest market in the world. But the scale is colossal. The numbers we deal with, right? At our peak, we were signing up 100 clients a day, and they were giving us roughly $10 million a day, right? So that sort of scale for a small firm is hard to take. So I think India will scale over the next 10 years again, but the numbers are vast. Thankfully, this is a tech-savvy country, but small firms like us have to invest in tech very early to be able to deal with scale. So I think those are the three big differences. The communication is easier in your part of the world because both sides are used to the discourse. The regulatory construct is stabilized in your part of the world, and the scale is more modest. Here, the scale is colossal.
Go ahead, Vatsal.
Saurabh,
Ask something.
yeah, Saurabh, one question I wanted to ask again, a lot of the people who are watching the podcast are people who aspire to be money managers who are already established money managers. And given that you are a proponent of long-term investing, how do you manage long-term investing with short-term client expectations? How do you manage clients who are breathing down your neck or during drawdowns or market crises, they're ringing your phones. How do you manage these two sides of the coin?
So this was the piece that we had to learn the hard way through 2022 and 23 Vatsal. The first 4 years was easy because portfolio was doing well and everybody was happy, and we could say we were doing long-term investing, and the client said, keep doing it. It's just working out really well for everybody, right? And 22, 23, the same style backfired. And obviously people said, my God, you've lost me a ton of money. What are you going to do about it? So 23 was the year we retooled ourselves. And the retooling basically meant that we said that rather than positions, I'm just simplifying 23 and the retooling in 23. Simplification was rather than just basing position sizing and investing on the back of EPS growth. Till 23, our North Star was EPS growth. The greater the EPS growth of the company, the bigger our position size. So in 23, we said rather than position sizing just basis EPS growth, we will position size basis IRR. And how do we get to IRR? To keep it simple, IRR is EPS growth plus whatever dividend yield the company is giving, minus whatever we expect the valuation to do over the next 5 years, right? And if if a company like HDFC Bank had already corrected, then the EPS growth and the IRR would be broadly similar. And if a company like Trent has had a stellar run, we can still be very bullish on the EPS growth, but we expect a degree of mean reversion in the valuation, and therefore the IRR expectations would be duly moderated. That construct, which we implemented in 23, has served us really well over the last couple of years. It's helped us beat the benchmark. More importantly, when a client calls and says, "What are you guys doing in this market correction?" As you probably aware, both of you are aware that since September last year, the Indian market's been correcting. We've been able to say that in our small and mid cap portfolios, we are sitting on 30% cash because the valuations are egregious, the market is too expensive, the economy is cooling down, and we're keeping an eye on high quality stocks. As the valuations tank, we will be moving out of cash back into equities again. But for the moment, basis our valuation discipline, basis the reversion to mean on valuations, we believe this is the right time to sit on cash. So the communication piece has become easier. But I think more important than the communication piece is our own discipline on taking money off the table has come to the fore, especially since August last year, when we realized that the economy was tanking and valuations were somewhere in the stratosphere.
Yeah, one question I want to touch on as we get towards the end of the episode is, I'm more global in my mindset. Really, most of my assets and focus is on America, and my clients are here as well. But if somebody is a U.S. investor or perhaps a European investor, and they're trying to think about where to allocate their funds, where does India fit into the pantheon of options? What would be how would you sort of handicap India versus other opportunities that we have? Continue to invest in America, invest in Asia, invest in Europe, invest in South America or Africa or wherever. How do you think about that question?
So look at the context of emerging markets. And we've been saying this for many years, long before the Trump-China punch-up. In the context of emerging markets, if we look at the data over 10 years, 20 years, 30 years, India stands head and shoulders above any other emerging market. The dollar returns over 20 years, I think, at 10 and a half. I think only market in the world, emerged or emerging, amongst the large markets, the only market which has matched India shoulder to shoulder for returns over 10 and 20 years is the United States, right? No other emerging market is even in the same ballpark as India. Now, why has India been able to beat the living daylights out of all other markets, all other emerging markets, and all other emerged markets, barring America? I think there's a lot to be said for free market democracies. Right? Free market democracies are noisy. They look messy and ugly from outside, but they deliver because they have two things which are very important. They have contestability of political power. If the guy running the country screws up, he gets voted out in a free market democracy. In a country like China or Russia, it's a very different reality. Secondly, free market democracies have contestability in the economy itself. So if the company screws up, they lose their place in the market, somebody else takes over. So there's two levels of fitness. There's two levels of Darwinian fitness embedded in free market democracies, which is why the world's two largest free market democracies have been on the leaderboard, number one and number two. United States and India, but number one and number two on the leaderboard. So on that basis, I've long believed that the allocation that global allocators give to India is ridiculously low. I know they do some MSCI Act-free business and they justify the low allocations in the back of that. But for many years now, when I go to America and I ask someone how much have they allocated to America, I can say $200 million. And then I ask them how much is allocated to India. Well, we don't have an India allocation. Right? And I say, well, why don't you have an India allocation, right? And part of me almost feels like asking them, how do you justify your job if you don't have an India allocation? You're sitting here allocated to China for 10 years. If you open a Bloomberg terminal and look at Chinese free cash flows, Chinese ROCs, Chinese compounding, Indian free cash flows, Indian ROCs, and Indian compounding, there's a night and day difference. All of that being said, as I said through August last year, August, September to the current day, we told Western allocators that don't allocate more to India at the moment. India is richly valued. The economy is tanking. Wait for the valuations to come off. I think we are little more than halfway through the valuation correction in India, Ken. I think there's a little bit more to go. I think large caps are still 10% overvalued. I think small caps in India are 30-40% overvalued. But I think that correction will come. And when that correction comes, I hope the allocators who are watching will be loading up on India, because otherwise, to have a bigger allocation to China than India makes no rational sense. Whether you look at free cash flows, ROCEs, 10-year compounding, EPS growth, underlying economic fundamentals. And these sorts of valuation windows where India tanks, India comes out 20-25% in a year, they come along once a decade. When you get those windows, it's a great time to load up on India.
It's actually interesting that you said the large caps are actually more reasonably valued than the small caps. I would think more of the activity is in the large caps, so why wouldn't it be the opposite?
No, I think the retail investor in India has gone berserk on small caps.
Okay.
So through COVID, people spent 2 years sitting at home, fiddling on their brokerage apps. And by the end of those 2 years, they were utterly hooked to putting money into small caps. And there's very little underlying liquidity. Many of the small caps, say 500th or 550th stock in India by market cap rank will trade $100,000 a day. So if you're getting, say, $100,000 every hour going into those stocks will run up 60, 70, 80%, right, in the course of 2-3 years. And everybody who's invested will get a sugar rush. They'll put more money. They'll go to the bank and borrow money and put money, right? So all of that's happened. September last year, it started unraveling.
Uh-huh.
I think we're only halfway through the unraveling. Small and mid caps, that is. There's still plenty of illiquid small caps with weak fundamentals trading at 30, 40, 50 times earnings. I think that will get corrected in the next 6 months. And in large caps, I think another 10% will be at sensible levels. And I suspect the valuation bottoming out will happen before the economy bottoms out. It might take the economy another year to bottom out, but the valuation bottoming out, and my reading is will happen before that.
Got it.
So these windows come along every decade, once a decade, either a Lehman type event in your part of the world
Yeah.
or something back in our part of the world causes a cratering of valuations.
Hmm.
That's when the retail investor throws in the towel. When the retail investor throws in the towel is the best time for its institutional allocators to put money to it.
And last two questions on my end. What do you see India looking like in say 10 years or 15 or 20 years relative to the West?
So my reading is that the government of India gradually will ease capital account convertibility, which means they'll allow Indians to invest freely abroad. So at the moment, the government puts a restriction on us, on Indians, for those living in India, we're only allowed to invest in $50,000 per annum abroad, right? But I think those restrictions will go as capital account convertibility comes in. We can freely invest abroad. I think the rupee will devalue. The rupee will get cheaper. As the rupee gets cheaper, Indian exporters will become far more competitive. We have good beyond IT and pharma. IT and pharma are the sectors India is known for. Beyond IT and pharma, we have a fairly competent, high quality manufacturing setup, but they are handicapped by a overvalued exchange rate. If we if we introduce capital account convertibility, our exchange rate will devalue, our exporters will become more competitive. And the third thing is, I think we'll see that massive amount of physical assets, real estate and gold, right? $10 trillion of it. I reckon if we speak to each other a decade hence, I think another couple of trillion of that easily will be in the stock market. Stock market today is around $3.5 trillion. A decade hence, I'll be surprised we aren't a $10 trillion stock market.
And just related to that, if the rupee will devalue more so than previously because of capital account convertibility, won't that be a headwind to dollar investors?
So it will be, but I think it will be more than made up by underlying EPS compounding. So if you look at the picture since 91, the rupee has given up around 3% of its value each year since 91. Yet in dollar terms, America and India are reasonably similar, 11% dollar returns, total shareholder returns over 20 years, right? Now assume that the rupee rather than giving up 3 gives up 5. I think we'll be more than able to make it up, especially given what's playing out between America and China. I think we'll be able to make it up on the export side. A competitive exchange rate will help us deal with imports coming in from China. It'll help us be more competitive in exporting our stuff into the Western world. It'll also mean an easier monetary policy regime, right? Usually, if a currency goes down, foreign money comes in. It's an easier monetary policy regime that will help track down local cost of capital. So I think people like me are going to carry on canvassing for this, right? We are whoever we are, whatever we might say might be ignored by the powers that be. But I think many people like me are knocking on the door saying, can we please have lower interest rates, more liquidity in the financial system, and an easier exchange rate regime so that we're able to become more competitive in the global market for products and services.
It seems to be an opening with what's going on with China and tariffs anyway. So
absolutely, yeah. I think there's an open goal for us. We just have to kick the ball in.
And last thing on India before we ask the last question is so obviously you're a bottoms up investor. You're looking at micro factors, ROCE, and earnings growth as your main focus. How about top down? Like, are there themes that if somebody isn't familiar with India, you think are have strong tailwinds and probably have a long way to go?
So 6 months ago, I published a book, Ken, with our economist Anandita. The book is called Behold the Leviathan, Unusual Rise of Modern India. And in that, we highlighted 5 themes, right? So we call it WESCO. WESCO is the acronym, right? So Indian women are now better educated than men. They have more money in the bank than men, and they have more money in the stock market than men. Right? A massive theme. They are the gender on the ascendant in modern India. Second is a newly educated elite, right? University education. University education in India is low cost, it's spread far and wide. And for the first time since the country got independence, we're seeing that the majority of successful Indian companies are run by people not from India's elite IITs and IIMs or from overseas. They're run by local graduates. There's a newly educated elite coming through. The third theme is Southern India. So the southern 7 states can account for a quarter of India's GDP, for half the GDP, for a quarter of the southern 7 states account for a quarter of the population, half the GDP, and 2/3 of the GDP growth. These states are growing at 8-9%. They've been the fastest growing region in the world for the last 10 years. Good law and order, high quality education, great infrastructure. I think this part of India, southern India, which accounts for 2/3 of our GDP growth, will be the most dynamic region in the world over the next 10 years. Fourth is China plus one, as we discussed, right? As China and America punch up, there'll be room for India to grow manifold in many sectors. And the fifth is outsourcing. Right? Our take when we wrote the book 6 months ago was, and it's stronger now, that if room for Western companies to outsource manufacturing to China diminishes, Western companies will outsource all their office work to India. Sales, marketing, HR, payroll, all of that will end up coming to India. Not just IT, but the whole 9 years of white collar jobs will move to global capability centers in India. So those are 5 themes in Behold the Leviathan. We've identified the themes, given the macro drivers of that, and then tried to give some sense of how this theme will play out in the next 3-4 years.
Right, and that's the book that you gave us, and
that's the book we have. I hope you managed to sort of fall asleep on the flight reading the book.
I read it, and that's why I actually asked the question.
Thanks, Ken. Thank you so much.
Get up, and I recommend the book to anyone interested in India or just investing in general. Last question. So we're creating the Capital Alliance. The Capital Alliance podcast is related to that, and it's a group for money managers. And one of the insights that we had, which I'd love your thoughts on, is that in a world which is increasingly connected technologically, it's less and less easy to find community and to find true connection. And so that's why we're actually creating this sort of network of a very selective network of the greatest people around the world who are committed to transparency and vulnerability and humility and coming together multiple times a year. I just wanted your thoughts on sort of, as your career has progressed, where do you find community and like-minded people who are interested in the similar things, and what do you think of the importance of community in professional and personal growth?
Look, kudos to you for building this, because I at least I hadn't heard of any similar setup globally till Vatsal and you highlighted this to me. We've tried to create something similar in India, the Association of Portfolio Managers in India, but that's more of a trade body, Ken. It's more of a trade body than a kind of space where we can be vulnerable with each other. And because of the needs of the Indian regulator, PMI APMI as we call it, APMI has become very active, but it's full of performance standards, TWRR, XIRR, fees, and so on. So we haven't yet been able to cultivate the shared space for sharing insights, emotions, and vulnerability. I think what you've created is powerful. I hope that it does very well, and whatever I can do to give you guys some support in India, let me know, because I think we need more of this. Many years ago, right, when I was building Clear Capital, a really bright young guy came and interned, Cambridge graduate. He came and interned with me. I thought he was 21, 22, full of energy, full of spark and life. I then migrated to India, as I said, in 2008, and I read about him. He became a star fund manager by 2017, 2018. He was a star fund manager for a famous fund house in the UK. Then COVID struck Ken, and his fund underperformed in the first 3-4 months of COVID. It underperformed pretty badly. For a star young fund manager, that was his first period of underperformance, right? And just imagine, right? This guy was 32, 33 years old, bright kid, Oxbridge education, the world at his footsteps, earning God knows how many $1 million a year, but he couldn't deal with that underperformance, right? And then one day I woke up in the summer of 21 and I read in the British newspapers online that he'd walked out of his house late at night, walked into the local lake, and was never seen of again until the cops found his body a couple of weeks later. And that's the challenge of our profession. It looks seductively glamorous from outside, but the pressures of it are intense, and the whole world is looking. And you feel when you go through phases like that, young fund manager goes through a phase like that, sitting at home with underperformance, you tend to believe that this is the end of the world. I think for many reasons, I think what you're building is valuable. not least, it'll give all of us a place to go and share our battlefield stories.
Yes, thank you. Thank you for sharing that. There's actually a few other stories, I won't share them, of quite prominent people much later in their career in this business who succumbed to
It's a really tough job.
depression, other obviously there are obviously mental disorders as well, and it's obviously always tragic to hear of somebody who had everything in their fingertips and yet kind of lost the plot, unfortunately.
So thanks for doing this. Thanks for building Capital Alliance. All power to you guys. Let me know how I can help. And thank you for hosting me.
Thank you.
Thanks for watching this episode. Go check out our conversations with Peter Sliggers and Gautam Bide. Links are on screen. And if you're a fund manager, join the Capital Alliance waiting list below.